For this session, we will talk about your long-term financing. So remember, as part of our financing, we can either have a finance from our current liability, non-current liability, and your equity. So current liability financing comes from your short-term financing, while your non-current liability and your equity is discussed here in your long-term financing. So again, our main issue here in your long-term finance is how do we raise funds through our long-term finance? How do we raise funds through our long-term finance? So let's start. So the sources of finance. Your sources of finance can either be liabilities or your equity. So for your liabilities, you all know that that is your debt that can either be current or non-current. And then we have your preferred stock and your common equity. But as you can see in this figure, this source of finance purely talks about your long-term finance, purely talks about your long-term finance. So long-term notes payable, other long-term debts, your preferred stock, your retained earnings, and your new common stock. As we have discussed during our very first meeting, that your asset is equal to your capital or your equity. So your asset is financed either by liability or by your shareholders' equity. So for your liability, you have your current and your non-current liability. So your current liability was already discussed during your midterms. Our main focus now is your long-term financing through non-current liabilities and through your shareholders' equity. Now, your capital structure. So your capital structure is known as the mix of the long-term sources of funds. So when we say mix of long-term sources of funds, of course, this can either be your non-current liability plus your equity. So we look into the proper mixture of this. Soon we will discuss about your optimal capital structure. So this is the best structure of your capital. So when we say capital purely, by the way, in your financial management, if we look into capital structure, we look into long-term liability and equity. If we are talking about your financial structure or your short-term finance, we are looking into your current liabilities. Therefore, please do not confuse yourselves about these terms because, again, financial management is different from your accounting. So, again, in financial management, when we talk about capital, we are talking about long-term liability and equity. When we talk about financial structure or financing or short-term financing, we are talking about your current liability. Soon, when we try to look into the proper mixture of your long-term liability and your equity or your non-current liability and equity, we will discuss your optimal capital structure. So the best capital structure, the best capital mixture of your long-term sources of funds. Again, capital structure and financial structure as a subset of your financial management in your raising of funds or raising of your assets. Long-term finance. So what is long-term finance? Long-term finance is used for major investments and is usually more expensive and less flexible than your short-term finance. You already know that normally your long-term finance is more expensive because, again, you have a long term to pay for the cost of that particular finance. However, for short-term finance, although it has a higher rate, you will only pay it for a uh, short-term interest. Now, for your long-term finance, take note, it is used for major investments. Unlike your short-term finance, you use it in case you need a particular amount of money for your operations or to cover the excess amount or the bottleneck among your financing. So in case your finance is not enough, then what we do is we try to get from your short-term finance as we have learned during your midterms. But now, we don't use long-term finance for your spontaneous types of operations. As you all know, we try to match it. Spontaneous operations should be matched by your spontaneous liabilities or other current liabilities. But if that is for long-term operations or for major investments, you try to match it with your long-term finance. This is again in turn depending on how do you manage your finances. Are you aggressive or are you conservative? So generally, it depends on how you really manage your finances. But as a rule of thumb, you use your short-term finance for your short-term operations or for your normal operations, and you use long-term finance for your major investments. So if we talk about your long-term finance, you will only talk about two types of long-term finance. That is your long-term debt and your equity finance. Again, short-term finance, we try to emphasize this one. Short-term finance comes from your current liability. Long-term finance comes from your long-term liability and your equity. Therefore, as we go through our discussion, you will see that most of our financing comes from either your long-term or your equity. Let's start now with your debt finance or your long-term liability. So what are the factors influencing your debt finance? First, of course, is the availability because it is not so easy to get any debt finance. Normally, they need a lot of requirements before you can be provided out of that debt financing because the longer the debt is, of course, the company should project that they could really pay the debt or the liability within that period. Next, of course, is your credit rating. So, of course, aside from whether you can really pay, you look into the credit rating of that company as towards the other finance sources. So, you try to compare the credit rating from one bank to another bank and look whether the particular customer has a good credit rating. Next, of course, is the amount and the duration. This talks about the total amount of your finance and how long will you pay for that finance. Next is as to your interest, whether it is fixed or floating rate. So when we say fixed, it does not change. When we say fixed, the interest does not change. While when we say floating rate, this is a variable type interest rate. Variable type interest rate. And lastly, any security or covenants to cover your liability. So mostly, you know this one as mortgage. So that can either be a chattel or a real estate mortgage as your security and covenant. So these are different factors in influencing whether you can raise a debt finance or none. So debt finance. Your debt finance normally comes from your term bonds. So when we say term bonds, uh, when we say bonds, it describes various long-term bonds. So that can either be a floating rate loan, a term loan, a zero coupon bond, and a convertible bond. So when we say floating rate loan, this is a type of loan wherein we have a variable rate loan. Next, we have your term loan. This is more of a fixed type of loan payable within a certain period of time. Zero coupon bonds, you have zero stated rate, but you have an effective interest rate or yield to maturity or yield rate. Next, you have your convertible bonds. This is a bond with a conversion option. Okay, so when we talk about debt finance, these are the different items that we need to learn as to the financing of our debt. Whether we will finance it through a floating rate or a term loan or a zero coupon or a convertible bond. As we said, when we say floating rate, it is a variable rate loan. So when we say variable rate, normally this is indexed at the market rate. It is indexed at the market rate. So whatever is the market interest rate during the start of the current year, that is the rate of your loan. While we have term loans, normally this is a type of a fixed loan, which is due within a certain period of time. Zero coupon bonds. When we say zero coupon, it means there is 0% stated rate or 0% coupon rate. By the way, stated rate is also known as your coupon rate, meaning at the face of the bond, there is no interest that is stated on the particular band. Next, we have only here your EIR or your yield to maturity or your yield rate. Finally, we have your convertible bonds, which is a type of bond with a conversion option. So when we say a bond with conversion options, it means that the bond can be converted into your equity. Your bond can be converted into equity. Because normally, when we say convertible bonds, it is only a conversion to equity. There's no conversion to another liability. Generally, it is a conversion to equity. So a bond with conversion option is known as a convertible bond. So let's start with the very first type of debt finance. We have your floating rate loan. So your floating rate or FRN is a debt instrument with a variable interest rate. We have already discussed this one. So when we say variable interest rate, there's no fixed interest rate that is stated on the note or to the loan. So no fixed rate, there is a variable interest rate. The variable interest rate is tied to a benchmark rate. And this benchmark rate, as we said, is your market interest rate. So in the Philippines, your market interest rate is normally fixed under your BSP or it is fixed per your market. So since floaters has variable rates, they tend to have unpredictable coupon payments. So when we say coupon payments, this is known as your interest payments. So when we say interest payment, this is equal to your face amount of your loan or your band, and then you multiply it to your rate. So since the rate here is variable, therefore, there is unpredictable coupon payments, meaning unpredictable interest payments, unlike in your fixed. So if we try to compare fixed versus variable, so let's say your fixed is 12% and your variable, the market interest rate on year one is 11.5. On year two, it is 13% in year two, and year three, 14%. Okay, so if we have a fixed rate at 12% and our amount is 1 million, year one, year two, year three, for your fixed is always the same. So it is still 12%. So 120,000, 120,000, and 120,000. For your variable, if ever it is variable, it is indexed on your market interest rate. So our market interest rate on year one is 11.5 times 1 million, so 115,000. 13% times 1 million is 130,000. 14% times 1 million is 140,000. So as I said, if you have fixed coupon payments, meaning your interest payments is equal during the term of the loan. But if you have variable interest payments, your interest payments differs from each year depending on the benchmark rate. And our benchmark rate is your market interest rate. So as you can see, fixed you have equal, while in your variable we have unequal because it is based on your market interest rate. Now let's talk about the second type of your debt finance. This is a term loan. A term loan is a monetary loan that is repaid in regular payments over a set period of time. So as I told you, it is fixed within a particular period of times. Within a particular period of time. So normally, a term loan is a type of an interest-bearing loan. And when we say interest bearing here, we have a fixed interest. We have a fixed interest. So unlike a while back, we have a floating interest. So floating means variable, indexed in the market interest rate. When we have fixed, whatever is the stated or the coupon rate, this is the amount of our interest. And we have already differentiated coupon payments of fixed and floating. So how do we compute for your loan proceeds? Your loan proceeds is equal to your regular payment times your present value of ordinary annuity. And the regular payment of the term loan is equal to your loan proceeds or all over your present value of ordinary annuity. So this regular payment is derived from this main formula. If we like to get the regular payment, you need to remove the PV of ordinary annuity. That's why our formula now for regular payment is equal to your loan proceeds over PV of OA. And for loan proceeds, you all know this one. Loan proceeds or the issue price, it is equal to your face or your payment multiplied by your present value factor. Okay? Face or payment multiplied by your present value factor. So let's try to have an example. So term loans. Lean Incorporated has just negotiated a 3-year loan payable annually at 1,292,194.441. The annual rate of interest is 14%. What is the loan proceeds? So again, the loan proceeds is equal to your regular payment multiplied by your present value factor. So our regular payment here is 1,292,194.441 for 3 years. And this is our interest rate, 14%. So we use PV of ordinary annuity of 1, n is equal to 14%. N is equal to 3, I is equal to 14%. So that present value factor is 2.321632027 times 1,292,194.441. Our loan proceeds, or also known as usable amount, is equal to 3 million pesos. That's equal to 3 million pesos. So this is just quite easy. So again, loan proceeds or usable amount is equal to your regular payment multiplied by your present value factor. And if you want to know your regular payment, that is equal to your loan proceeds or usable amount divided by your present value factor. Let's have another example. Celltite Incorporated has just negotiated a 5-year term loan of 8 million. So this 8 million is known as your proceeds or your usable amount. The loan is fully amortized at an annual rate of 12%. What are the required annual payments? So this is 5-year term. So we compute the present value of ordinary annuity. I is equal to 12%, N is equal to 5. We will get 3.6048. So loan proceeds all over the PV of ordinary annuity, we will get our annual payment of 2,219,263.20. Okay? So that is our regular payment or our installment payment. So again, loan proceeds is equal to your regular payment times your present value factor, and your regular payment is equal to your loan proceeds divided by your present value factor. Next, the third debt financing that we will discuss is your zero coupon bonds. So what is a zero coupon bond? A zero coupon bond are bonds that are issued at a discount to their redemption value, but no interest is paid on them. Why is there no interest paid on them? Because it has a 0% interest or 0% stated rate or 0% coupon rate. Take note, stated rate is the same with your coupon rate. Okay? So zero coupon meaning there's no interest. Sometimes this is known as non-interest bearing. Okay? Sometimes this is known as your non-interest bearing. So what is the price of zero coupon band? So the price of zero coupon band is computed by getting the present value of your principal. So this is equal to your face amount multiplied by your present value factor. And your present value factor generally is based on your PV of 1. So based on your present value of principal discounted over the yield or effective rate or internal rate of return over the term of period. As I told you, I is known as your yield to maturity, yield rate, effective interest rate or effective rate, and internal rate of return. So those are the different terms pertaining to the I here. Yield to maturity, yield rate, effective interest rate, effective rate, or internal rate of return. So this is quite easy. You just need to get for the face amount multiplied by your present value factor. The present value factor here is PV of 1. So let's try to compute. A zero coupon band with a 1 million par value, 1,000 par value and a maturity of 8 years has a yield to maturity of 12%. What is the current price? What is the yield to maturity remains constant? What will be the band 7 years before maturity and 1 year before maturity? So again, we just need to get the PV of 1. So PV of 1, what is the current price? N is equal to 8, I is 12%. And then 7 years before maturity, so N is equal to 7, I is 12%. 1 year maturity, N is equal to 1, I is equal to 12%. So you just need to get for the present value of these items, you multiply it to 1,000. So let's try to compute. So as we said, for the current price, we use 8 because it has a maturity of 8 years. Price before 7 years, so we use is equal to 7. And what is the price if ever 1 year before maturity? Since 1 year, we use 1. So again, you just need to get for the present value of 1. N is equal to 8, I is 12%. N is equal to 7, I is 12%. N is equal to 1, I is 12%. So 1,000 times 0.404. The price of the zero coupon band is 404. If 7 years before maturity, 452. And if it is 1 year before maturity, 893. Meaning you can raise 1,000 bonds and sell it at yield to maturity of 12%, you will only get 404 pesos. Okay? So if you will raise 1,000 par value zero coupon bond at 12%, how much can you raise? Only 404. But if you will sell it 1 year before maturity, how much can you raise? 893. Okay? Zero coupon bonds. And then we have your deep discount bonds. So deep discount bonds are bonds or loan notes issued at a price which is a large discount to the nominal value of the notes and which will be redeemable at nominal value or above nominal value when they eventually mature. So this differs between your stated rate and your market interest rate or your effective interest rate generally. But for financial management, what we look is the redemption price versus the nominal value. So we talk now about your yield to maturity or your yield rate. So yield to maturity is the total return anticipated on a bond if the bond is held until it matures. So anticipated on a bond if the bond is held until it matures. Yield to maturity is considered a long-term bond yield, but it is expressed as an annual rate. In other words, it is the internal rate of return of an investment in a bond if the investor holds the bond until maturity with all payments made to schedule and reinvested at the same rate. So as I told you, yield to maturity is also known as your effective interest rate, market interest rate, market rate, or internal rate of return. Why is it called yield to maturity? Because that is the rate until the bond matures. Okay? The rate of return until the bond is matured. So that is the rate of return of an investment in a bond if the investor holds the bond until maturity. So how do we compute for your yield to maturity? To compute for your yield to maturity, we use this approximated yield to maturity. But actually, in the board exam, this does not come out. They don't normally ask for approximated yield to maturity. But we still need to discuss it, approximated yield to maturity, because we just don't know when will it come out on your board exam. So approximated yield to maturity is equal to your coupon plus face less price divided by the period divided by face plus price divided by the number 2. Number 2 here is fixed. Okay, as the term itself, it is only approximated yield to maturity. It is not the actual yield to maturity. The actual yield to maturity is computed using a trial and error method, which is not part of our discussion, but will be discussed in your financial accounting and reporting or in your intermediate accounting. So here in your FinMan, normally we will only discuss your approximated YTM. So coupon, you all know that one as interest payment, coupon plus face plus price divided by N divided by face plus price divided by 2. So let's try to answer this. Husky Enterprises recently sold an issue of 10-year maturity bonds. The bonds were sold at a deep discount of 615. After flotation costs, Husky received 604.5. So this is the price. The bonds have 1,000 maturity value. So this is the face and pay 50 interest. So this is the coupon. So what is our formula again? Your approximated YTM is equal to your coupon face less price divided by N, face plus price divided by 2. Okay, so first, we have already our coupon at 50. And then we have your face, which is 1,000, less the price of 604.5 divided by the period, which is 10-year maturity. So period is 10-year. Price is 604.5. Face is 1,000 and 50 is the coupon. Divided by face plus price divided by 2. So the face is 1,000. The price is 604.5 divided by 2. Again, 2 here will be fixed. Therefore, what is our approximated YTM? It is 11.16%. Again, please do not forget the formula, coupon plus face less price divided by n all over face plus price divided by 2. Again, we will only approximate the yield to maturity, but we will not compute the actual yield to maturity. But assuming we will compute the actual yield to maturity, what is the actual yield to maturity? The actual yield to maturity is the rate used to discount the interest and the principal to arrive at the issue price. Again, to get for the actual yield to maturity, that is the rate to discount the interest and the principal to the amount of the issue price. So our issue price here is 604.5. So what is the PV of interest and PV of principal? The rate that we will use to get 604.5. So here we use the percentage 12% to get 604.5. So PV of interest, I is 12%, N is equal to 10. So this is PV of ordinary annuity of 1. And then PV of principal, we have here PV of 1, N is equal to 10, I is equal to 12%. So if we use this and discount the interest and the principal, then we can get the yield based on the issue price, which is 12%. So as you can see, it is actual because whatever is the discounted rate or the discounted amount gives you the issue price. Again, for actual yield, what we need here is your present value of interest and present value of principal during the periods, during the term of the band, which should approximate or which is equal to the amount of your issue price, the rate, which approximates now the issue price. So here the rate is 12%. Okay, so yield to maturity, what we learned, we have two types of yields. We have your actual yield, which approximates, or it is the rate which equalizes the amount of your issue price after getting the PV of principal and PV of interest. And we also have your approximated YTM, which is not the actual, but it nearly approximates the amount of our yield to maturity. So this is coupon plus face less price divided by N divided by face plus price divided by 2. Okay? YTM. Now, we talk about how do we raise funds through deep discount bonds. To raise funds through deep discount bonds, we compute for the face amount of the discount bonds that is equal to your usable funds divided by your issue price all over your par value. To compute for the usable funds, that is equal to your face value, issue price all over par value. So this is most likely your face value multiplied by your discount rate. Discount rate is to be computed at issue price divided by par value. Okay. As an alternative to zero coupon bonds, Pacific Oil is considering the issuance of discount bonds. The bonds would have a 10-year maturity, 1,000 par value, and a 6% coupon rate, even though the yield to maturity is to be expected at 14%. Okay, so if this is the case, normally we have deep discount because it is issued at a discount, meaning the stated rate, there is a difference of at least 5%, greater or equal to 5% as compared to your coupon rate. So our stated rate here is 6%. Our coupon rate is 6%, and our effective interest rate or your yield to maturity or your yield rate is 14%. So generally, we get the expected price of each bond. To get for the price of each bond, we just need to get for the PV of your principal and PV of interest. So the coupon payment multiplied by your PV of ordinary annuity of 1, and then the face amount multiplied by the PV of 1 using your effective interest rate. So our effective interest rate here is 14%. Sir, where did we get the uh, 60 amount here in your interest? As I told you, the 60 amount of interest here is based on the coupon payments. So we have here 6%, right? Multiplied by 1,000, that will give us 60. Okay? I know you have finished this one in your financial accounting. So it is quite repetitive now as to the computation of your price of your bonds. But I hope that even if it is repetitive, it could also help you in knowing how to raise your amounts for the bonds. So our purchase price is 582.96. So our issue price is 582.96. Now we compute for the amount of our face value. So we need 400 million. So face value is equal to your usable funds divided by issue price over par value. So our issue price here is 582.96 over 1,000. So 400 million divided by 582.96 over 1,000, we will get 686,153,420. So take note, for every 1,000 bond, you can only issue it at 582.96. Therefore, for 400 million, you need the every 1,000 band. Okay, you need every 1,000 band. You can only issue it at 582.96. Therefore, how much is the total fund? So in every 1,000 band, take note, our issue price is only 582.96. So how many 1,000 bands are there? So 400 million divided by 1,000 band. So we have 400,000 bands multiplied by 582.96. 400 million, 582.96. Parang nabaliktad ko. We need 400 million, which is issued at 582.96 for every 1,000 band. So what we did here is we need to multiply 400 million to the 1,000 divided by 582.96. We will get 686,153,420. Okay, 582.96 divided by 1,000. And then 400 million divided that amount, we will get 686,153,423.9. It is just rounded to the nearest peso, which is 420. Next, how much is the usable funds? So for usable funds, we multiply it to your face value to the issue price and par value. So Husky Enterprises recently sold an issue of 10-year maturity. It is 604.5. So this is our issue price. 1,000 is the face. And the total face value of the bonds issued is 496,277,915.6. So to get for the usable funds, 496,277,915.6. So this is the total face value. How much can be only used out of that face value? We have 300 million. If you multiply it to your 604.5 over 1,000. Okay, so we already discussed, I think, three debt finance. The first one is your floating rate notes or loans. So this is based on a variable rate, which is benchmarked at your market interest rate. You have also your term loans, which can be computed using your present value. And then we also have your zero coupon bonds. So under your zero coupon bonds, what we have here is to compute for the issue price of our zero coupon bonds. Issue price is equal to your face amount multiplied by your present value of 1. And then we have now your yield to maturity to compute the actual yield. Your yield to maturity can either be an actual yield or an approximated yield. If that is an actual yield, you need trial and error to get the actual rate. While for approximated, have your coupon plus face less price divided by n all over face plus price divided by 2. And now we have your dip discount bands. Under your dip discount bands, generally, we need to get first your issue price. Issue price is equal to your PV of interest and PV of principal. Then we can now make use and compute for the amount of our face value. So face value or face amount is equal to your usable funds divided by your issue price all over the par value of our loan or band. If we get the usable funds, it is now face value multiplied by your issue price all over your par value. Okay, so do not forget these different formulas in getting or in knowing the amount of our funds to be raised out of our debt financing. Another debt finance is your convertible bond. A convertible bond is a bond that gives the holder the right to convert to other securities, normally ordinary shares, at a predetermined price or rate and time. So as I told you, convertible bonds is a type of bond with conversion option. So the question here is, what is the conversion option of that convertible bond? The conversion option of that convertible bond is to convert the band to ordinary share or a preference share. But normally, it is ordinary share, but it can be converted also to a preference share. Now, in a convertible band, we need to know the conversion value and the conversion ratio. The conversion value is equal to your conversion ratio multiplied by market price per share, and the conversion ratio is computed as the face amount of bond all over the conversion price per share. So now, conversion value is also known as the current market value of ordinary shares into which a band may be converted is known as the conversion value. It is also known as the conversion price. Okay, so conversion value is equal to conversion ratio multiplied by market price per share or face amount of band all over conversion price multiplied by your market price. Face amount all over conversion price times market price. Okay, find the conversion price for a convertible band, which is 1,000 with a conversion ratio of 15. The market price of the common stock is 47. So again, conversion value is equal to conversion ratio multiplied by market price. The conversion ratio here is 15 and the market price is equal to 47. 15 times 47, our conversion value is 705. Okay, if we try to go back again, conversion ratio is equal to your face amount all over the conversion price. Okay? And conversion value is equal to your conversion ratio times market price. Another conversion value of convertible bonds. Find the conversion price of a convertible 1,000 band, which is convertible into into common stock at 20 pesos per share. So this is your conversion price. And then the market price is 18. So conversion value is equal to your face divided by your conversion price multiplied by your market price. Our fees is 1,000. Our conversion price is 20. And our market price is 18. So 1,000 all over 20 times 18 is 900. Or you can go to the long cut. First, compute for your conversion ratio. 1,000 divided by 20, we have 50. And then we compute for your conversion value, which is 50 over 18. Sir, why is conversion ratio known as face amount all over conversion price? Because if we have 1,000 band and you can convert it into common stock at 20 pesos, how many shares can you convert? So how many 20 pesos share are there in 1,000 band? There is 50. That's why it's known as conversion ratio. So a share is only worth at 20 pesos and a band is worth at 1,000 band. So how many one band, how many band or how many share can be converted out of one band? If one share is only 20, so 1,000 divided by 20, how many shares can there be? 50. And you multiply it now to your market price, that is the amount of the conversion or the value of the conversion of the band. Next, we go with your conversion premium of convertible bonds. So conversion premium is the difference between the current market value and the current conversion value. So market value versus conversion value. You already know how to compute for conversion value, right? Face divided by your conversion price times the market price. Conversion premium is also the percentage rise on the current conversion value before the conversion rights become attractive. So that is rise of conversion value multiplied by your current conversion value. So premium, because there is a difference as to your market value and your conversion value. Okay. A convertible 1,000 band has a conversion ratio of 15 and the current market price is 47. So our conversion value here is equal to your conversion ratio, which is 15, multiplied by your market price. Our conversion ratio is 15 multiplied by market price of 47. This is 705. And then you compare it to your market price, which is 846. The difference known is premium. Why is it premium? Because this is only the value at the conversion, but it is now sold in the market at 846. So there is an excess, and that excess is known as a premium. That excess is known as a premium or a conversion premium. Another, a convertible 1,000 band has a conversion ratio of 15 and the market price of the common stock is 47 per share. The band is quoted at the market at 846. So to get for the rise of the conversion value, we get the conversion premium all over the current conversion value. So the current conversion value is based on the conversion ratio multiplied by the market price. So that is 15 multiplied by 47, so 705. To get for the rise of conversion value, we have conversion premium of 141. That is equal to your market price less the conversion value. Market price now is 846. The conversion value is only 705. So that is 141 all over current market value. So we have 20% rise on conversion value. Or to get for your conversion premium, that is rise multiplied by your conversion value, which is 705, you will still get 141. So iniikot-ikot lang talaga yung formula dito sa FinMan. As long as you know the formulas and as long as you know the rationale behind it, then it would be easier for you to answer problems here in your financial management. Next, we look into the price of your convertible bonds. The price of convertible bond is equal to the present value of interest and, of course, the present value of the redemption price or conversion. So it's or, meaning it can either be redemption price or conversion. So when do we need to add the redemption and when do we need to add the conversion? If redemption price is greater than conversion value, then redeem. If redemption price is lesser than conversion value, then convert. So take note, if greater, redeem. So you add the redemption price. So this is equal to PV of interest plus redemption price. But if redemption is lesser than conversion value, then converts. So conversion price plus the present value of interest. So take note, the price of convertible bond is either equal to the price of the interest, PV of interest, plus your redemption price, or PV of interest plus the conversion. When can we say we use the redemption price? If redemption is greater than conversion value. When do we use your conversion? If redemption is lesser than your conversion value. Okay? To get for your conversion value, that is your number of shares times the value of shares. Okay. So price of convertible bonds, TD has issued 100 convertible bond at the coupon rate of interest of 10% payable yearly. The bond may be converted into 40 ordinary shares in 3 years' time. The bond, if not converted, will be redeemed at 110. Estimate the likely current market price for 100 of the bonds if investors in the bonds now require a pre-tax return of only 8%. The expected value of CD ordinary shares on the conversion day is 2.5 per share and 3 pesos per share. And take note, as we said, to know the value, you must know whether you should redeem or you should convert. To know whether you redeem or convert, you compare the amount of the conversion to the redemption price. So let's compute first for 2.5 per share. So for 2.5 per share, we can convert 40 shares. So the conversion value is 2.5 times 40, we have 100. And the redemption price is 110. If we go back here, you can convert 40 ordinary shares and the conversion value is 2.5. So 2.5 times 40, the conversion value is only 100. And the redemption price is 110. If the conversion value, if the redemption price is 110 and the conversion value is only 100, what will you do? Which is higher, redemption or convert? It is redemption. So it is proper for you to redeem rather than convert. So if it is proper for you to redeem, then you should redeem. So how do we compute if it is redeem? If it's redeem, it is PV of interest, including the PV of the redemption. The PV of redemption is 110. So as you can see, since the redemption price is greater than the conversion value, we will now redeem. We get first the PV of your interest for the 3 periods. So 10, 10, 10. And then we get the PV of your redemption value at 110. At 110. Okay? Sir, how did we get this one? You get the pre-tax rate. So this is PV of 1, N is equal to 1. Here, N is equal to 1. I is equal to 8%. Here, N is equal to 1. N is equal to 2. N is equal to 3. N is equal to 3. Okay? Next, what if the price is 3 pesos? If the price is 3 pesos, our conversion value now is 3 times 40. So this is 120. Our redemption price is only 110. So conversion value now is greater than redemption price. Therefore, what will you choose? You choose to convert. If you choose to convert, it is the PV of interest plus the PV of the conversion. Okay? PV of interest plus the PV of conversion. So here, we have the PV of conversion now at 120. Is still we use PV of 1. I is equal to 8%. So this is now the value. So again, in a convertible bond, what is important? It is important for you to determine whether first you should redeem or whether first you should convert to know what you should add here in the principal. It is the value of your redemption or is it the value of your conversion? Take note of this. So again, it's still present value of interest plus present value of your principal. But your present value of principal differs now whether you are to redeem or whether you are to convert. We go now to your equity finance. So for equity finance, this is raised through the sale of ordinary or preference shares. So we're done now with your debt financing, and we have discussed the different modes in financing your assets through debt. So we discussed until convertible bonds. Now we are into your equity finance. So how much can we fund through preference shares and or ordinary shares? So equity finance comes from either ordinary or preference shares. To get for your equity financing requirement, that is equal to your equity portion multiplied by your fund requirement times equity retained. Equity retained is equal to your any equity currently held by the entity. So when we say equity portion, because uh, fund requirement can either be a requirement from debt or equity. Therefore, we will need only the equity portion of the fund requirement. That's why we have here a multiplier of equity portion multiplied by fund requirement. Because when we say fund requirement or financing requirement, that can either come from your debt or equity. And since we're only computing for your equity finance, we only need to get for the equity portion, less any equity retained for your any equity finance requirement. So let's try some examples. Wolverine Corporation has a capital budget requiring an investment of 4 million over the year, and it desires to maintain present debt to total assets of 4.4. So therefore, zero point 0.4 is the debt and zero point 0.6 is for the equity, right? Okay. And 4 million here is the fund requirement. Assume Wolverine's capital structure is only common equity. How much is the equity finance requirement? So if we have 0.40 debt, we have zero point 0.6 equity needed. So 4 million fund requirement times zero point 0.6, we need 2.4 million equity finance. It's quite easy because you know that we just need to get the value of the equity to be financed, the amount or the rate of the equity to be financed. Here, the rate is zero point 0.6, therefore zero point 0.6 of 4 million. Since there's no equity retained, we don't deduct anything. How about here? Wolverine Corporation plans to pay P3 pesos dividend per share on each of its 300,000 shares next year. Wolverine anticipates earnings of 6.25 per share over the year. Wolverine has a capital budget requiring 4 million over the year, and it desires to maintain 0.4 debt ratio. How much is the external equity? So we already know how to compute for this equity portion. And this is 2.4 million, right? Now let's compute for your equity retained. For equity retained, this is equal to your income less any dividend paid. So income less dividend paid, 6.25 less 3, we have 3.25. 3.25 times 300,000, we have 975,000. 2.4 less 975 will give you 1,425,000. 1,425,000 for our equity finance requirement. Next, we compute for the number of shares, financing required, all over subscription or issue price. So after we get the financing required based on our formula, then we can now compute for the number of new shares. So let's try this problem. Diebold Pulp and Paper has decided to raise 20 million through a subscription of common stock. It has 2 million shares of common stock currently outstanding that sell for 120 per share. It has decided to set the subscription price at 100 per share. So fund requirement divided by your subscription price. So we need 20 million out of new shares. So if our subscription is 100, 20 million divided by 100, how many shares? The number of shares is 200,000. The number of shares is 200,000. Another example, the Addington Book Company has the following equity position. The stock is currently selling at 3 pesos per share. What was the average price at which the company originally sold its stock? Okay, so here, to get for the issue price, that is the value of your common stock, plus paid in excess. Paid in excess is also known as your share premium. So 16 million plus 4 million divided by the number of shares, which is 8 million, plus 16 plus 4 million divided by 8 million. How much is the cost per share? It is 2.5 per share. So the average price therefore is 2.5 per share. Okay. And last but not the least, the preference shares. Preference shares are shares which gives right to receive dividends, typically a fixed percentage of the nominal value of the shares before any dividends can be paid to ordinary shares. Because normally preference shares has preference as to dividends. Okay? So long-term finance, we have two that can either be debt financing for long-term debt, and then we have equity financing. For debt financing, we have discussed different items. First, we discussed your floating rate loans or notes. We have also your term loans. We also have your zero coupon bond, deep discount bond, and lastly, we have your convertible bond. And for equity, we have discussed two. We have preference shares and equity shares, particularly ordinary shares, but more so, we place emphasis on ordinary shares. Okay? Do not forget the different formulas on how do we raise funds based on either debt finance or equity. Take note, we have a particular fund requirement, and based on the issue price, how much bond or how many bond and how many shares can we issue based on the fund requirement and based on the issue price, how many bonds and how many shares can we issue.